At Greengrow CPAs, we see a lot of different tax scenarios for cannabis businesses. And as you may know, 280E locks down cannabis businesses to claiming CoGS as their only deduction. So the age-old question is, how do you back as many indirect and direct costs into CoGS to offset your revenue and lower your tax burden? Well, what if you actually produce more product this period than you actually sell? How do you bank those costs for later to help you in subsequent periods with your taxes? Well, we're going to explore all that and more in this video. But if you have any questions about cannabis business accounting or need help with your cannabis CoGS, then please reach out to us via our website at greengrowcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation. Now, before we hop into the topic today, I need to let you know that the information contained in this webinar presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So first, 280E in legal cannabis businesses. Now, 280E was implemented to stop illegal drug traffickers from, working on their taxes and being able to deduct all these different expenses and lowering their tax burden, right? So Al Capone didn't really go to jail for doing all those heinous crimes. He actually went to jail for tax evasion. So now with 280E, it's causing huge problems for state legal cannabis businesses when it was initially intended to stop illegal drug traffickers from fixing their tax returns. Now, cannabis is a Schedule I controlled substance, and that's where 280E comes in. If you're operating a business that deals with Schedule I controlled substances, you can't really take any of those ordinary business expenses that regular businesses would take. These SG&A expenses, things like marketing, office supplies, sales wages, things like that. But using some other tax codes and accrual accounting, you can partially unlock your business from the 280E tax code. Now, as you understand with 280E, COGS is the only deduction that has been generally accepted by the courts. Okay, now the age-old question is, how do you back the most costs, direct and indirect costs, into COGS? Now, what we've noticed throughout working with hundreds of clients is that most operators are calculating COGS improperly or they don't have a reasonable methodology to back up how they're actually calculating it. One thing is, how are they allocating employee time? How are they allocating specific input costs? How are they actually splitting these costs between COGS and inventory? Or are they even splitting them between COGS and inventory? Now, this can create terrible outcomes if you ever get audited, which seems like a bigger possibility nowadays compared to an ordinary business. Some evidence coming out of Colorado through some of our legal partners, they're saying 1 in 5 cannabis businesses will be audited at some level of the government versus 1 in 20 ordinary businesses, maybe even 1 in 30 ordinary businesses. Now, the government's going to come looking for their money at some point. Now, you need to have some type of reasonable methodology to back up all these tax filings that you create, being able to reconstruct bulletproof financial records. So that brings me to the goal of this video and the example that I'm going to walk through. So I have two main goals throughout this presentation. First, I want to explain to you how you can actually reduce your cannabis taxes. So here we are, the example of cost tracking allocation and the methodology behind it. So what we're going to do is we're going to walk down the simplest example that I can create, which is a cultivation operation. And I'm going to keep it simple because this is one where you essentially produce all of your own products. We're just going to do this as a pure buy clones, sell pounds cultivation business. No pre-rolls, none of that stuff. I don't want to get into too granular of detail because you can get very confused very quickly. It gets very complicated when we start doing, from cultivation to manufacturing or even vertically integrated businesses. And you'll understand as we go through the process why that is. So there is 4 steps to this reasonable methodology process. Step 1, identify the costs that are inventoriable. Step 2, defining equivalent units of measure. Step 3, calculate total costs in sales. In step 4, allocate costs to COGS and inventory. So let's start with step 1 here. Step 1 is identifying costs that are inventoriable. Now, for a cultivator, the product costs are going to include direct materials, direct labor, and the cultivation overhead, which is fixed and variable costs. Now, what you're going to do is look at all the costs incurred during the period that you're measuring, whether that's a month or a quarter. Typically, it's going to be on a monthly basis. And you're going to go through your QuickBooks or your Excel file, wherever you have all of your costs laid out, and you need to delineate differentiate which costs are potential inventory costs and which do not qualify as inventory. And you're likely going to need a cannabis CPA to help you make these choices when you start out. And this is one of those things that we help out with during our outsourced CFO service for cannabis businesses. But at a high level, you can pretty much reasonably say that the labor to produce the product is going to be inventoriable. Raw materials, which is like your grow supplies, your nutrients, your clones, your grow equipment, which is the lights and your hydro systems, things like that. And then any packaging supplies to help create those final units, those final pounds to get out and be sold. Now, things that you see are not inventoriable are selling costs, office supplies, or any marketing costs associated with selling those products. Now, the second step in the process is defining equivalent units of measure. Now, why is this important? Again, I brought this up earlier, but you're going to need to track the progress of your business's production and sales in a specific and consistent unit to be able to break down those costs from step one and allocate them accurately into COGS and inventory. Again, we're trying to unlock 280E from your business. Now, for cultivation, an equivalent unit of measure is going to be plants, and then we're going to convert that plant into pounds of flower and trim by calculating an average yield per plant. And for manufacturing, your equivalent unit of measure is going to be grams. You buy grams and produce grams, so this makes sense. Now, this is not one-to-one with pounds of flour due to the yield percentages, so there is obviously going to be some kind of conversion. Now, you're starting to see a lot of multiplication in here, and this is where the complications come in, and that's why I'm just going to stick with a pure cultivation example. And this brings us back to knowing how long it takes to produce a plant from clone to final trim ready for sale. Okay, the problem is this. You have plants in the ground, but they're not all the same maturity. So we need to convert them into your equivalent unit of measure, which is going to be pounds. And we're going to use what we call percentage of completion. Very self-explanatory. How complete is this plant? So this is why you need superb tracking of your cultivation production. And after 4 to 5 harvests, maybe you realize that one plant yields a half pound. And that's the plant to pounds conversion rate that I spoke about earlier in this slide, right? When I said for cultivation, the equivalent units of measure is plants, then you convert that into pounds. So that's your conversion right there. For this example, we're just going to use one plant gives you a half pound. And if you have 10 final mature plants and a half pound per plant, that's 5 pounds of equivalent units. Now, here's where it comes into understanding the full process. We may have plants that are at a specific stage of the growth cycle and we have to adjust by the completion. So for example, say you have some plants that are 25% into the completion days or the completion cycle, you're going to multiply that by the half pound. Okay, so 5 plants that yield a half pound each that are 25% done within their 100-day cycle. That's 5, so 5 plants times a half pound, okay, 2.5 pounds, and then 25% complete equals 0.625 pounds of equivalent units. I hope that makes sense. You're going to be breaking down and, things are not going to be fully at that half pound. They're going to be partially way through. As you start to see, there's a lot of math to get involved in this. And this is a very basic example. But just a quick peek at multi-license, cultivation and manufacturing or vertically integrated all the way through retail, you need to have the same equivalent unit between cultivation, manufacturing, and then through your retail to really do proper allocations. So you start to see 6, 7, 8, 10 multiplications here when you get to multiple licenses, right? Converting plants into pounds, into oil grams. There's a lot going on here. And again, you need to track the yields of the plant cultivation and the oil production and maybe your pre-roll production. So that's why we're going to stick with a simple example here. Now, step 3, calculating costs and sales. Now, after you understand and identify which costs are inventoriable and your equivalent units of measure, we need to figure out what are the total costs. So from step 1, you incurred all of those inventoriable costs for a particular month, say for the month of February. And that came out to, say, $80,000. Now, the question is, out of this total, we need to figure out how much of that goes into inventory and how much should be flushed through your P&L, your profit and loss statement, to COGS. Okay, you would think the quick answer is that, hey, it's all COGS, but that's not the most accurate answer to unlock the power of accrual accounting on your cannabis tax filings. And so now we understand the costs are $80,000. We're going to look at the sales this period and we'll just say it's $60,000. Okay, you're going to use this to calculate your margins once we're done with this entire exercise. I'm not going to go over the calculating of the margins. It's very simple. It's, how much did it cost divided by how much did you sell it for? That's your gross margin. Now, step 4, the meat and potatoes of this entire presentation, allocating those costs to COGS and inventory and how you actually do that. So what you're going to actually need to do this exercise is you're going to need the quantity in equivalent units at the beginning and end of the month, and then how many equivalent units were sold during the month. Now again, I'm going to simplify this and not even show all the calculation of plants in progress at each stage. I'm just going to give you the final numbers because we could be here for 20 to 30 extra minutes if I broke it down that much by all the plants in progress. Just understand that you're going to need to calculate equivalent units on a percentage basis of that completion so you can get to what we're trying to work on here. And if you really, really want to learn how this works and have this done for your business, then reach out to our team and we can implement all this tracking and allocation for your cannabis business. Now, we're going to go over 2 examples, a first month example of a brand new business and a second month example. And again, I'm simplifying things here so you can really just look at, okay, we're putting some costs here and some costs here and why we're doing that. So the first month example, this one is the easiest to understand. The beginning inventory or the beginning amount of equivalent units is 0 units. Now, the total units is 160 pounds produced in month 1. We're just grabbing this number. It's an arbitrary number, just trying to make it easy to understand. Some of those are not fully grown. Just again, no, I'm not showing the breakdown of plants that are at a certain percentage of completion. We're just going to go for simplicity's sake and say 160 pounds produced. And you're going to have 40 units sold, and that's going to be in plant pounds, right? That's the equivalent units. And the ending inventory is 120 units, plant pounds. Now, month 1, there is $80,000 in inventoriable costs from the last slide. We added that up. So what we're going to do is do a little bit of a calculation so you know how much goes to COGS and how much gets put into inventory. So we produced 160 pounds. So the average cost per pound is $500. 80,000 divided by 160, that is going to be $500 a pound. Now, we need to allocate that $80,000, some to COGS and some to inventory. So we're going to allocate $20,000 to cost of goods sold. Really, when you hear the word COGS, you really need to pay attention to that last word, cost of goods sold. Okay, some of these pounds that you produce were not sold. Only a percentage of them are. So what percentage of that was actually sold? It's 40 of the 160 pounds. So 25% of that $80,000, which is $20,000. Or you could just do the math and say, all right, we have $500 per pound, 40 pounds got sold, so $20,000 to COGS. This is where it's really important to understand what your true cost per pound is. And then you have the balance of that is going to be allocated to inventory, which is $60,000, right? The 80,000 minus the 20,000 is 60,000, or 120 pounds that is in the ending inventory divided by the 160 that's totally produced. That's 75% of 80,000, which is $60,000. Or you can do the 120 pounds times the $500, which will get you $60,000. All those ways will get you essentially to that last inventory number there. So if we add up cost of goods sold allocation and the inventory allocation, 20,000 plus 60,000, that gives us the $80,000 in total inventoriable costs for month 1. Now that's how you reasonably break down the costs into COGS and inventory. Now we're going to go over the second month example. So this business has now been operating for 2 full months. We have the beginning inventory of 120 units, and this is from the month 1 ending inventory. And that total value there is $60,000 because we're doing the $500 per pound, and it was the same, $60,000 in ending inventory total there from month 1. Now, the total units produced in month 2 is 100 pounds. We sold 140 units in plant pounds. And the important thing to notice is that we sold more than we produced. And that's where this whole reason of having inventory costs is very, very important. And then the ending inventory is 80 units. Now, in month 2, we had $50,000 in inventoriable costs. So let's set up this ratio and do this allocation. So we produced 100 pounds, and that average cost to produce a pound is still $500. Again, I'm keeping this very, very steady and simple here. So $50,000 is going to be allocated to COGS because this is this month's total expenditure since we sold all the cannabis, and it's $500 per pound. So $500 times 100 pounds is $50,000. Now, this is using LIFO, last in, first out inventory, instead of FIFO, which is first in, first out. Just for the simplicity of this example, I don't want to show, bringing some in and then some out of inventory. I just want to keep it very simple. Now, you're also going to have to do what we call an inventory adjustment because we sold more pounds than we actually produced. So you pulled some stuff out of inventory to sell. Now, this is where it's very important to have an inventory balance, okay? So that inventory adjustment is going to be $20,000 because there are 40 pounds that we sold out of inventory at a cost of $500 per pound. And then the ending inventory balance would be $40,000. There's 80 pounds sitting in there at $500 cost per pound. Now, if we didn't allocate some of those costs in month one to inventory, then you would have no way to allocate any costs to COGS for those additional pounds that we sold that we didn't produce in this month. So that's a problem. You would have a very, very high tax burden at that point. This is why it's critical that you make accurate inventory allocations. You can really see how this can get incredibly complex if we use another conversion for plant pounds to oil at this point. When you start doing that vertically integrated or from cultivation to manufacturing into retail. So this here is an example of month one and month two, showing in month one that those total costs of month one get broken down very easily, $20,000 and $60,000. But in month two, since we sold more than we produced, we had to take some of those inventory costs out and allocate them to COGS, creating an adjustment, an accrual adjustment here for your business so that you can accurately have COGS for that second month.